Thanks everyone for joining us. This is our Q3 2023 webinar. We will be, if you're not familiar, we'll go through each of the strategies' performance and provide some additional commentary and color on them. And then we will have time at the end for questions. If you already submitted a question, when you registered, we have that. If you have any other questions pop up as we're going through, just type them into the chat box and we'll address them all at the end. So with that, let's get started. Quick disclaimer, this presentation is for informational purposes only and should not be considered a solicitation. Futures and options trading can be risky. Please carefully consider if it's appropriate for you. We'll start with the cockroach strategy, as I mentioned. So the cockroach strategy posted some small gains in July, mostly riding on the back of some equity gains. That story obviously changed in August and September, where we saw a bit of a sell-off. This period was a bit of an echo of 2022, and that we saw stocks and bonds sell off together a bit. The income bucket in cockroach actually did all right due to our carry strategy in there, and I'll talk a little bit more about that later because that's had a really good year and made a meaningful difference in the performance of the overall strategy. Something we've talked about quite a few number of times is just the stock and bond correlations going higher is not something that's necessarily unusual over a sort of 100-year time period, but has been unusual lately. And I think a lot of how the portfolio is constructed and what we expect out of it is it's prepared for that sort of scenario. The sell-off that happened in August and September was a bit of a volatility-less sell-off, volatility-free sell-off. The S&P was off around 7.5% from its 2023 highs mid-month in September. And as I mentioned, bond yields were rising and the bond sell-off kind of continued. The VIX did bump up a little bit, but not what we would sort of consider an actual volatility spike. And again, that's not unusual. It's sort of 7.5% sell-off in the S&P is not what we would consider a tail event or a risk-off sort of move. And the VIX didn't really react that way. Investors didn't seem to react that way. There wasn't much of a bid for volatility. The trend portion has had sort of an interesting year of back and forth, and Q3 was kind of a continuation of that. It's almost exactly flat on the year. It's up about 11 basis points, the portion inside of cockroach, and there's just kind of been some whipsaw up and down there. The fiat hedge bucket had a strong start to the year and has posted some modest losses since then. Broadly, the way we look at cockroaches, this is a long-term strategy with a long-term memory, and the volatility and trend portions are intended for those periods where you do see significant moves. I think we saw one of those in 2022 with some big trends in commodity markets that the trend strategy was able to capitalize on and contributed a lot to the overall portfolio. We haven't seen either of those environments really in 2023. And so that's reflected in the performance. But overall, we'll go into some more detail about some of the sub-strategies, but feel good about where everything is positioned and how it's responding relative to the environment that we're in. I did want to highlight, I mentioned the income strategy has done surprisingly well on the year. That's not because bond performance has been good. So as a quick reminder, the income sub-strategy inside of cockroach has an allocation to US and international bonds, as well as a carry strategy. So this year we've seen a tough year for both international and US bonds, but the carry strategy has really come in and done quite well, particularly in Q3. And I think that's the diversification we would like to see out of that bucket, that even in a challenging environment for bonds, that sort of sub-strategy is still able to sort of hold its own. And I think sort of more broadly, part of the way we think about constructing the portfolio is, we talk about these four major buckets of, growth, recession, inflation, and deflation or disinflation that we diversify across with the four sort of sub-strategies, but also diversifying within those sub-strategies and how that can be meaningful. And I think the carry strategy is a good example of that so far this year. Taking a look at cockroach and sort of some of the comps, the 60-40 and permanent portfolio, it struggled relative to those these years. This year, that's not unusual and something we, having 1 year of or 9 months at this point of modest underperformance relative to those is something we saw in the back test and something we would fully expect. A lot of that is the volatility sub-strategy that struggled this year, which we'll talk more about in a minute. Zooming out a bit further, since inception, the cockroach strategy is modestly outperforming sort of a traditional 60-40 stock bond portfolio. I think we really saw 2022, the value of some of those defensive portions particularly trend that in what was a very challenging year for 60-40 portfolios, even though the cockroach strategy is holding a fair amount of equity and bond exposure, was able to buoy that. So I think, should we enter that environment again, strong commodity trends, elevated inflation, we would anticipate the strategy would do, the trend sub strategy would do well. Again, and similarly, we haven't really seen an environment that the volatility strategy, we haven't seen a big pop in vol since the cockroach strategy launched. But we do feel well about how that portfolio is positioned, and we can talk about that more in the volatility section. Jason, anything you want to add to that?
Let me come off the mute real quick. No, not until we get to the volatility section. I'll add a little bit of color, but I just want to highlight some of the things you said. Obviously looking at cockroach this year, you got to combine with last year, and as you're showing in this chart, that's great. Also, just a reminder for, I've been letting people in since we got started. So if you came on a little bit after we got started, this is being recorded, and we'll try to get this recording out to you later this week, if not by next week. So Taylor, if you want to continue on, then we can kind of dive into each strategy.
If I had a quick comment on the, if you go back to the buckets slide real quick.
Sure.
And just to remind people that stock line item, right? That's our, as Taylor said, ensemble of US and inside US, NASDAQ, Russell, S&P, and emerging and foreign. So that diversification this year has underperformed versus S&P. I think the NASDAQ through September was up like 35 or so. Russell was up 1. So just a note that diversification can and will cut both ways. Some years that will be better. This year hasn't been. That was it.
Yeah, we should the 60-40 that we compare to, this is in the footnotes, but it's the VBanks ETF, which is going to have some more US exposure. So that does kind of throw it off a little bit.
Yeah, and those comps are always going to outperform, not always, but most of the time going to outperform when there's a strong stock rally, right? Because it's 60% stocks. That permanent portfolio one is a little heavier stocks. So anytime you have a strong upward, especially in the S&P, that's going to, they're going to see quicker up and larger down.
Yep. So moving on to the commodity trend, as I mentioned, kind of a lot of up and down this year that's resulted in being mostly flat. July, not a lot to see from an overall return standpoint. Sort of the big trade really going back to 2022, if not 2021, is the sort of short bonds trade on US and European markets. That was up a small amount in July as interest rates were climbing over that month. And then everywhere else, it was pretty quiet. Energies, metals were all pretty low volatility without any pronounced trends. In August, we saw quite a bit of dispersion. As a sort of reminder, the commodity trend strategy uses short, medium, and long-term trend followers. And the reason we do that is we're trying to diversify what our friend Corey Hofson has called sort of rebalance timing luck, that, knowing exactly how long the trends are going to last is effectively impossible to predict. And so we want to be capturing them on multiple time frames. And we saw sort of a good example of that in August. The shorter and intermediate models, so something in the range of a few days to a few months, had a challenging period down sort of in the 3 to 5% range, while the longer term strategies, with many months of look back, were about flat. Sort of the bright spot was, again, the short bond trade in August. And then I think also sort of notable in August was a lot of the losses were not trade exits. They didn't sort of get out of the trade in the trended end. They just sort of had open trade losses, and that actually set us up quite nicely in September. Most of those trends rebounded, and our managers were able to capture those losses because those trades were still open. And then I think just overall, it's a good period to note. I mentioned in August sort of dispersion between sort of short and medium term managers and longer term managers. But that's not unusual. That was a big part of what we looked at in the research we did in constructing the portfolio and how we think about, improving it going forward. If you look the last 15, 20 years, there's a lot of dispersion among trend following managers. That's fairly typical. It's pretty unusual to see one manager persistently performing year after year after year. It tends to cycle quite a bit. And so that's very deliberate on our part. And we think that is a better long-term approach. And then looking at some of the comps, I think on one of the webinars last year, we had a question about sort of a commodity trend following approach versus a buy and hold commodity approach. I think we believe the commodity trend following is going to do a lot better over time. This year's certainly been one example that it's been able to do all right, even as sort of commodities themselves have declined. And Jeff, Jason, anything you want to add on commodity trend?
Yeah, I think that Jeff will give better color, but I just want to reiterate something you just said, Taylor, is that we try to find managers still pretty heavy in commodities, and even some of the more smaller commodity markets. What you're not going to see necessarily reflected in a lot of indices or other vehicles that you can get access to for a commodity kind of trend strategy. Jeff?
You stole my thunder a little bit. If you're looking at across the space, some of the better performers in Q3 were heavier in bonds, heavier in financials. September saw gains in currencies, gains in bonds and fixed income. So the less commodities, the more of those you had in September, the better you did. And then on the far other spectrum of that is some people doing very esoteric markets that aren't necessarily available to all, have done a little bit better. So kind of a nothing blah quarter, right? We had a bad first quarter and trend, a good second quarter, and now just a flat third quarter. So just chugging along, doing what it does. It'll be more exciting on this call next quarter. It's been a bit of exciting Q4 so far.
And I'll add there, I think we always think of all these sort of sub-strategies within the context of cockroach. So the reason the commodity trend strategy is heavier in commodities as opposed to a lot of other trend managers that might be heavier in like financials, as Jeff said, stocks and bonds is, that's really its role in a portfolio is, when you see sort of pronounced inflationary trends in commodity markets, that's when we're expecting it to do good. And so I think 2022, we saw that, we saw those trends, we saw it do well, and sort of serve that role in the portfolio. So, if those trends don't exist, inflation is low for some extended period of time, and the commodity trend strategy is flat over that period, we're totally happy with that. Again, it's all sort of like, what is its role in the overall portfolio? Jumping into the volatility strategy, we talked at some length in last quarter's Q2 webinar about some changes we made to the volatility strategy. I'll recap those briefly here, but if you want to go back and listen to that, we'll send out a link to that recording alongside this one, where we go into more depth. But to talk sort of briefly recap, historically, we looked at sort of 4 sub-strategies within the volatility strategies, which we referred to as long options, dynamic VIX, short futures, and rolling puts. We restructured the portfolio starting in July, and now we sort of think of it through these three strategies we have on the screen here, which are relative value, long options, and tail risk. Long options obviously is the same that previously existed and still exists. Relative value, that includes some of the dynamic VIX and these short futures managers, but also includes some more sort of pure market neutral relative value managers is maybe the best word. And the goal in including them there is to sort of help in this situation of flat to declining volatility markets. And then on the sort of other side of that, we bulked up or built out a bit the sort of pure tail risk, where we sort of, as opposed to a long option strategy that's trying to kind of dynamically come in and out of the market and time things a bit more, the tail risk is going to be that always on protection. So we feel like overall these changes are ultimately going to result in closer to the return profile we want on the volatility strategy, which is sort of flattish performance most of the time when stocks are trending up, when markets are quiet, and then still having that convexity in there when we see a big sell-off. In Q3, I think so far that seems to be working more or less as we would have expected. Q3 was a little bit of a frustrating period for a long volatility trader, just because we saw a bit of a sell-off in equities, but not really sort of that panic or fear set in where you'd see a big move in volatility. So we did see a bit of a spike, but not something that we would consider very material and sort of not enough to make a big move in option prices. If we sort of stay and return to sort of this prolonged low volatility environment, sort of our expectation is somewhat flattish performance, obviously with some up months and some down months over the long run. And then, we think that tail risk component is well positioned if we see a sharp sell-off in equities, whether that's something intrinsic, like the 2008 global financial crisis, or something extrinsic to markets like COVID was in 2020. And I'll also add on the tail risk piece, compared to, say, certainly late 2020 or 2021, volatility is relatively cheap. And so we feel quite good about sort of the convexity in those tail risk positions at this point. And then briefly take a look at some of the publicly traded comps. In general, it's been a tough year for volatility all around. I think you can, most of the volatility managers we track, that's sort of generally reflected. Jeff, Jason, anything you'd like to add to that?
Jeff, do you have anything you want to say before I get into the color from the managers?
Nope, go for it.
All right. Let's see. Let me close this down so I can see a little bit better. So this is just some color kind of across the space talking to our managers. I just want to, echo what Taylor said, is the adjustments we made in Q3 to the vol portfolio. Like, these are examples of the adjustments we made that we're very happy kind of with where we're at with those adjustments. Then moving on to the color, as Taylor said, it was more of like a September is the time to talk about long volatility, and is more towards that end of September, but it's also one of those kind of like staggered drawdowns, which is difficult for long volatility managers. But the markets retreated in September, and with that came, gain in implied volatility often seen by the VIX, albeit it wasn't a vigorous gain as we would expect starting for such low levels and in the context of historical S&P declines of similar magnitude. But in relative terms, the IV move was uneventful and fairly muted. On the equity market side, it was generally a broad drawdown, grabbing most sectors and indices for the ride, inclusive of the technology darlings that led earlier this year. The exception was the energy sector, which generated the only positive return in September, and which was only one or two advancing sectors in Q3 overall, with communication services being the other. Once again, in Q3, the CBO VIX index traded as low as a 12 handle, representing some of the lowest volatility levels that we've seen since the pandemic. We see longer dated out of the money put implied volatility decreasing. We believe this is likely due to a confluence of events, including the incremental growth in structured products post 2020. We've talked many times about structured products here and how that's really moving into the U.S. markets, when it was previously more of an Asian and European thing prior to kind of the pandemic. Investors are giving up on their hedges post the 2022 slow drawdown, and we see a reemergence of the short volatility and tail risk selling strategies by institutional players and multi-strategy funds. There's been a high demand for volatility-related strategies amongst the multi-strats, which tend to tip into short volatility. And I'll discuss that a little bit more maybe later. Volatility selling has become increasingly popular over time, with large groups of market participants viewing it as an evergreen asset class for income generation. This is especially true when it's been a while since the last crisis and tail risk sellers are emboldened. The point is that options are sometimes, but not always, expensive, and they have steadily become less expensive on average over time. VRP, or volatility risk premium, has been at a steady downward trend for 30 years. The key to understand is that derivatives markets are more easily influenced by supply-demand imbalance than primary markets. So understanding core concepts is the key. Derivatives markets exist because of end users. Retail investors buying structured notes for long-term investments, pension funds buying options to hedge their portfolio, and call overriders selling options for income. When themes within end users grow excessively relative to the size of the market, they significantly affect market prices and change risk premium. To put that more simply is, it's buyer and seller dynamics, right? It's that push pull, and then the more seller of all we see, the more those prices get suppressed. But then it also offers us more convexity. So there's trade-offs there, obviously. Another one of our managers talks about for most of the third quarter, risk assets remain range bound, as Taylor was kind of alluding to, as the Magnificent Seven, Apple, Alphabet, Meta, Amazon, Microsoft, Nvidia, and Tesla. It always makes me laugh about how these things always change over time, right? Was it FANG, then FanMag, and Magnificent Seven? We're always coming up with new things. The final 2 weeks of the quarter experienced a risk-off move, send the S&P down negative 3.6% on a total return basis. What made it feel worse, however, was that bonds sold off too. The ag index fell negative 1.67 for the same period. That's, of course, not how the finance textbooks say it's supposed to work. Last quarter, equities were fairly range-bound with extremely low realized volatility. Within the quarter, the S&P sold off that 3.2%, but realized volatility was sub 11%. Like we said, we saw implied get down to a 12 handle, but we saw realized volatility below 11. Interesting, the move lower in equities and rates did not result in a broad repricing of their most related risk. Implied volatility continued to fall, and credit continued to tighten. As one of our managers is also a credit expert, brought up the dynamics between credit and volatility, and I think probably a lot of people on this webinar have also read Chris Cole's when he talks about the dynamics between credit and volatility as well. But part of that more color is that credit is a slow-moving beast, but problems seem to be picking up pace as we enter the fall. Why is credit important to markets and specifically volatility? Financing is generally used to fuel growth, but it also acts as a backstop. The adage, never lend any money to anybody unless they don't need it, speaks volumes to the credit cycle. If there is an event where a significant amount of credit is needed, the financing is unlikely to be there. Volatility, expansion, and credit tend to be tied because of this common reflexivity to liquidity. Fundamental credit risks appear to be on the move, but have yet to influence pricing. Credit is the lubrication in the gears of the economy and the market. Cost of financing and access to credit impacts the day-to-day lives of individuals, corporates, and governments. Issues in credit generally start like a tornado, targeted destruction of a few specific segments of the economy. It usually takes many of these issues to create an economy-wide problem. Predicting the arrival of the main event is incredibly difficult because it takes much longer than anyone thinks. With limited ability to forecast such an aggressive negative asymmetry event, we believe the only choice in portfolio construction is an always-on approach with a positive asymmetric return stream. So this obviously echoes kind of our views of the markets as well. Some final thoughts that one from Q3 and even since then, is I have all these calls with our managers, with large institutional capital allocators, to clients, et cetera. Some of the stuff I'm hearing or color around the marketplace is, I'm starting to see some institutional traders or managers or some volatility specialists are starting to take the other side of these zero DTE options. So a lot of people, this was a big thing, earlier this year with the zero DTE, but the way people
just talk
really
about zero DTE real quick, just what that is.
0 days to expiration. So there are options that trade intraday, and they became, a large point of contention, throughout this year. But more importantly, people have been selling straddles on those 0DTEs. So they're selling calls and puts on an intraday basis. And if they keep rolling those every day, they create a nice income. The problem is if volatility breaks out, you can really get your face ripped off on that day. So I've been talking to some managers that are taking the other side, and they're actually opportunistically going long those straddles on that 0DTE basis as interesting hedges, and especially when they think they're relatively cheap, because once again, it's supply demand, right? It's buyer seller's market, and they're constantly battling out. The other thing that we're starting to see is, we've talked about in the past how dispersion trades, which is short, market index vol, long single name vol usually, those trades go in and out of vogue, but we're seeing some of these managers and some traders I've been talking to are taking the other side of that. Once again, they think that trade is kind of overrun its course. There's a lot of money piling into it. So they're happy with kind of the risk reward dynamics on the other side of that trade. Similarly, I'm talking to managers that are taking the other side of the hedged equity trades that we see like JPM and these other vehicles that you can find where those are becoming very massive in the markets. So it's suppressing those prices, which is making it difficult for those strategies to make money. But then it makes it it starts to look opportunistic for the risk reward on the other side of those trades. The other one that I kind of alluded to with one of our color from one of our managers is the idea of with the pod shops. So the multi-strategy pod shops of the world, I shouldn't probably name them, but they are, flush with cash. And when I'm talking to them, they were some of the only strategies that were kind of up in 2022. So you had a lot of institutional money chasing that 2022 performance. And we're seeing a flood of capital going to these multi-strategy pod shops. And even we're getting calls about, where's a good place for them to put money as far as relative value volatility or other volatility managers. But what typically happens from these pod shops is they tend to aggregate towards more short volatility trades. So we're seeing, once again, all of these things are indicating a much more rise since the pandemic happened of, short volatility strategies, which are kind of suppressing those prices at the tails, which makes that convexity look a lot more attractive on the tails. That's about it I have for the color, Taylor.
Would it be fair through all that color, Jason, just who you've been talking to say, right, this is more of a pre-Volmageddon in 2018, pre-COVID spike, right? Do you think we're at those sort of volatility selling levels and interest?
I think that in a way, yes and no. Like, I think it's really dangerous to say that, right? To use historical precedents and volatility, because as we talk about often, the mall markets can change dynamics pretty aggressively over a 2 to 5 year period, and they're constantly evolving, and the vol surface is constantly changing. What we are seeing, what's fair to say, is that we're starting to see much more vol selling than we've seen since the start of 2020. So pre-2020 was obviously tons of vol selling as well. Vol selling led into Volmageddon. So it's more about, being able to see the players come back into the market for selling vol, which is kind of suppressing those prices, especially at the tails. And then the question is, though, great, but does that mean any sort of event is on the horizon? Impossible to know that. But what's nice is the pricing versus the amount of return you could potentially get, i.e. the convexity, is generally improving for people that are looking to buy tails.
Just for those aren't familiar, Volmageddon was a 2018 event. I forget which month it happened in, but there was a February 2018 where there was an ETP that basically blew up that a lot of people had been selling, using it to sell vol sort of systematically, and it had sort of a reflexive kickback loop that I think it blew up in a day. I can't remember, in very short order. And I think we've talked a lot internally about the volatility and trend strategy are somewhat hard to talk about on a month-to-month basis or quarter-to-quarter basis because, to use the baseball analogy, their slugging percentage, they're sluggers. I don't watch that much baseball, as you can tell, right? But they don't have the best batting average, but the hope is that they hit some home runs, whereas the offensive portion, the stocks and bonds, are more like your sort of leadoff hitters that you'd expect them to get on base pretty frequently, but they're probably not going to hit those big home runs, right? So, in any given month or any given quarter, we wouldn't necessarily expect vol or trend to do as well, but in some months or some quarters, we'd expect them to do very well. And again, that's their role in the portfolio, and that's how we see them fitting into the broader picture. Talk about volatility. In stocks briefly, I mentioned the Q2 webinar, we talked about some changes we made to the volatility strategy. We also made some changes to the volatility plus stock strategy. So again, if you want to review that in detail, you can, we'll send out that link along with this link in the replay. But to briefly summarize, we basically added a overlay that has rebalanced daily with S&P exposure and a hedge strategy. So effectively, it gives double S&P exposure. So you effectively have 200% S&P exposure, and then about half of that is being rebalanced daily with a hedge program. And we like that from the perspective of, sort of more frequent rebalancing is very nice. The structure of the volatility strategy itself, we have over a dozen managers in there. It's just not feasible to rebalance it on a daily or weekly basis. So we rebalance on a monthly basis. But we were able to work with one manager to do a daily rebalanced strategy. Overall, the volatility and stock strategy has definitely struggled this year. The losses on the volatility side sort of dragged down the performance of stocks that rallied aggressively, or S&P that rallied aggressively at the beginning of the year. The new overlay program, we only have sort of 3 months of data so far, but some good, some bad. It hurt performance in July and September, but was additive in August. And so I think we've got to wait and kind of see how that plays out. But overall, we feel good about the changes and the sort of long-term implications there. Jason, do you want to add anything to that?
Nope, I'm good. Like you said, we're happy with where it's at longer term. Jeff, is there anything you want to add?
I think I'm good. I think just the takeaway, it's become, right, it's going to essentially match S&P volatility here instead of a lower vol. So I think on the longer term, we'd say similar volatility as the S&P, probably, with those spikes, those March 2020 type flip the sign, reverse the performance.
Yeah, and in fairness, like what you're both saying is that, on any monthly basis, like almost Taylor's alluding to, slightly up, slightly down, is that on those smaller moves, like we expect that volatility, but then once again, we have, all that volatility and tail risk when we start to, if we see those massive, like a March 2020 like drawdown, that's where we expect it to really, ballast the portfolio. But in any given month, it can be slightly better or worse than just a long volatility plus stocks, or a 60-40 portfolio, or just an S&P portfolio.
And then before we get into Q&A, I just give a little firm update. We wanted to start doing this, just kind of letting people know what's going on internally beyond just the strategy performance. So one thing we've are working on that's coming up is trying to publish some more of our research. We have a lot of internal research we've done over the past almost 5 years now that we haven't really shared publicly. And so that's something I'm working on over the next call like 6 to 9 months is turning some of that into outward facing stuff. So we're excited to do that, to talk about some of the decisions we made and why we made those decisions, and sort of the broad theory we have around portfolio construction. We also launched a new website this quarter. There's a number of advantages. The old website was quite basic. This one has a lot more information, a lot more accessible information around the strategies, their performance, what's going on, which we hope makes it easier to sort of track and monitor what's happening. And then a particular interest for existing investors, there is a current investors page, which has some common questions. It has an easy form. If you submit, it'll go straight to our investor relations team, and they can get back to you with any questions. And we'll also be able to use that to sort of communicate anything going on. So sort of K1 timing, when we're expecting it, that sort of thing. You'll have kind of a live update that we'll be updating periodically. On K1 timing, those were delayed more than we expected this year. I think they went out around the end of August. We sort of July, August was kind of what we were expecting. So towards the tail end of what we were expecting. Sort of long story short, the main sort of point person we had at our audit firm expected to get them done by a certain date in July. They weren't done by that date due to a few technicalities relating to one manager. That person then went on maternity leave, and then it took 2 weeks to find a new person and a few weeks to get a new person up to speed. We understand that's stressful, and I also wait on K1s from some people, and it's kind of annoying. So we have talked with them at length about that process and why it went wrong and what's going to be done differently next year. So we expect that to be substantially improved. We are a fund of funds. So due to the structure of fund of funds, we have to wait on getting all the K1s from our underlying manager, which we're usually not going to get until towards the end of June. So we hope to be able to turn around our K1s relatively quickly at some point in July. But just the nature of our structure is, we are looking at a few options of maybe if there's some other things we can do to get them out sooner. So we'll keep you updated on that, but sort of July is the timing I would expect going forward. We also, some of you may have that have either added, redeemed, or on board with us in the past 3 to 6 months. We've made a bunch of updates to that process. Our goal there is for it to be sort of the best experience of any private fund that you deal with in terms of getting money in and getting money out. We've updated our redemption process to try and get the funds back, most of the funds back to investors sooner. So we historically had to wait on accounting to be finalized, which normally happens around the 20th or 25th of the month, before sending out redemption proceeds. We now wire 90% of the proceeds in the first half of the month. So, we're open to suggestions there. We're always looking on some ways we can make it more streamlined and helpful for our investors. And then finally, not finally, I have 2 more points, but the Cayman Fund, we launched December 1 of last year. It's been live for almost a year. And we're seeing sort of more international investors coming in there. So if you are a non-US person or non-US entity that is interested in that, please reach out where we can talk about the setup there. And then finally, dare I say, our most exciting piece of news is we launched our new defense strategy. The defense strategy, one thing we noticed in our investors was a lot of people, for various reasons, wanted to handle what we would call the sort of offensive portion of the portfolio themselves. So they wanted to pick stocks, they did private equity investing, they did real estate investing, or another common scenario is just for tax reasons. People had a lot of gains on usually stocks, but stocks, real estate, sort of offensive things. And they were interested in incorporating defense into their portfolio, but it was difficult to do sort of the wholesale cockroach approach because they would have had to either get out of their offensive assets that they liked more than sort of a diversified approach, or sort of tax reasons, various other reasons. So we took the defensive portion of cockroach, the volatility strategy, and the trend sub strategy, and we just combined those into a single strategy, a single offering that's rebalanced monthly. So we have a number of investors that were invested in both sort of the volatility strategy and the commodity trend strategy. We think this is like a pretty obvious solution for those people. There's a single thing. You don't have to worry about rebalancing between the two of them. And there's only one thing to manage going in and going out. You can see here sort of the hypothetical performance, but it's a defensive strategy. You'd expect it to do well in defensive periods. So dot-com bubble, global financial crisis, COVID, and then sort of the 2022 inflation scare period. So this is, from our perspective, sort of an all-in-one defensive solution or defensive approach. It's using the whole commodity trend strategy, which is now at 6 managers, I believe, as well as the volatility strategy, which is at, I believe, 13 managers, 14 managers, or thereabouts. So you're getting all that diversification across commodity trend and volatility in a single offering, a single strategy. So the reception to that has been great, and we're excited about that. I think it'll become one of our more sort of popular offerings. So if you have any questions, you can email us, send in a contact form on the website. We're happy to talk about it. And it's also available via the Cayman Fund for any non-US investors. Because the defense strategy is hypothetical, I need to start this hypothetical performance disclaimer, as well as the sources and material assumptions. If you want to review that, it's available on the website. And with that, we will jump into Q&A. We'll start, I think, with the questions that were submitted via registration. And then if anyone else has questions, I see An put a question in the chat. Those in the chat either to everyone or where Jason or I can see them, and we will take those in turn. So first question, someone asked for just an update on new offerings and new managers. I talked about the defense strategy. That's our new offering. And then we also added done to our commodity trend strategy. It's also included in the commodity trend sub-strategy within Cockroach. Done is sort of one of the OGs of trend followers. I think their track record goes back to 1974. They've been around for quite a lot of time. So we have been working with them and figuring out a way to sort of structure things that made sense to have them in the portfolio. So we're happy to have them added and are sort of continuing to build out that portion. I think we launched with 4 managers in commodity trend and we now have 6. So we're talking to a lot of managers and we'll keep sort of evaluating where we're at there and who we want to add next. The second question was congrats on launching defense. What's next? I think sort of from a strategy perspective, our main focus right now is on building out what we have, of the existing strategies. How can we make them as good as possible? The defense strategy was kind of, as I said, a little bit of a response to investor demand and just relatively obvious thing, given that, we already had all those managers we'd worked with. We were already trading them. And so just structuring in that way, where it was all in one thing, was relatively, I don't know if it was a light lift for us. There's still quite a bit to getting a strategy launched, but made a lot of sense. And we already had a lot of the pieces put together. Someone asked if we were selling any hats. Jason had a few hats made for the team after we launched the defense strategy, but merchandise demand remains quite low. So we have not kicked up the e-commerce stores yet.
Yeah, no comment. I'm always experimenting with the merch, but just like what's Musashi's quote, the way you do one thing's the way you do all things. So it's like trying to find high quality merchandise that matches the artisanal quality of our portfolios is difficult.
And then we had another question about sort of fund performance since launch relative to historical backtesting. I wanted to talk about a couple things here relevant to this. I'm gonna talk mostly about the Cockroach performance because again, we sort of see the other strategies as components of a broader Cockroach portfolio, and in our view, you can't really talk about any of them in isolation necessarily. And then also along those things, we're always evaluating the portfolio based on how is it performing in this market environment relative to what we would have expected or relative to similar market environments in the past, right? So, if we were to compare, it launched in sort of late 2021 and say like, bonds have done much worse than usual. And is that something component of the strategy? Like, no, that's because there was a very strong bond bull market for a very long time. Most of the sort of backtesting we did went back to around 1990, 1991. And I'll mention for anyone that is a QAP, which means 2 million assets, you can go to our website and download the hypothetical performance going back further. We didn't verify any QAP status for this webinar, so we're not able to display it here for marketing purposes, but that is available. To anyone that qualifies as a QAP, just go to the website and click on the strategy you're interested in and click on in the right-hand column. There's a little icon that says QAP presentation or QAP tear sheet that has that. But sort of having said that, I think the closest historical analog to sort of since Cockroach has been live is maybe there's sort of a 94. There was a big Fed rate hike. That was somewhat similar. We saw it wasn't enough that you saw sort of big volatility pops, but you did see sort of modest sell-offs along most of the existing assets. But looking at sort of the sub-strategies independently, I would say that the trend performance since inception is more or less in line with our expectation, given the environments we've been in. Broadly, like 2022, it did very well. where we'd expect to do very well. In 2023, it's roughly flat in a situation where we would expect to be roughly flat or not doing particularly well. Again, there's not much to say in terms of equities. We're not equities have performed how they performed in the environment we've been in. Sort of same with bonds, of course. Bonds over the last 20 years, over the last 2 years relative to their historical performance has massively underperformed. But that's again the purpose of having the sort of trend and other pieces of the portfolio there is to balance that out, which we feel like they have done quite well. Fiat had stocks, bonds, kind of what you'd expect. I think it would be fair to say the volatility strategy has underperformed our expectations over that time period, but we feel the changes we've made in sort of middle of the year, it's going to be more in line going forward. And then I'll mention the carry sub-strategy that's inside of the income bucket has massively outperformed our expectations, honestly, and significantly outperformed the sort of historical performance. So that's been very additive to the overall portfolio. Jason, Jeff, anything you want to add to that question?
No, we can add.
I'll just say that.
Go ahead, Jeff. Sorry.
Just to your point, it's hard to separate, are things above, below average, or are they above, below backtest? Especially for cockroach, right? When so much of it is just tracking the beta pieces, stocks and bonds, we can easily say, yeah, it was below the averages for those asset classes. But does that mean the backtest? Right. To me, it means the backtest is valid and good. And I would put a finer point on the vol piece to say, doing exactly what we expect in the backtest in terms of showing up in these crisis periods. We haven't really had the crisis period, just bleeding a little more than possibly expected, but also the echo of vol from COVID and been a difficult environment for that.
And then semi-related, because An had asked a further kind of question about that. He said, that's kind of semi-related to what we're discussing. It says, regarding the volatility strategy, if I recall correctly, the original strategy composition was based on a 30-year back test shared in the pitch deck. If the weighting of the strategy is being updated now, does that put a lot more weight on recent history? Or do you think the original back test was overfit? God, there's so many things in there. I think we always try to touch on that, as I said earlier, that volatility markets are changing dramatically. We always said in the back test for, incorporating volatility, to me, if you have a back test that goes prior to like 2012 in the volatility space, you kind of have to throw it out the window as the markets have changed dramatically with the different players in the market. So the volatility side was always used as an intuition pump, as any back test should be. And the amount of changes you need to make or proxies you need to use to back test volatility or even tail risk strategies, make it difficult to even do any sort of back test. So it's not necessarily any sort of overfitting or overweighing. It was more about over time, as we added more managers, we got the broader diversification, we got the more coverage we were looking for to make sure we were truly protected to that downside risk. And so we've able to adjust as AUM has grown to make sure we still have all the coverage we're looking for, but then make slight changes as managers come in and out of the portfolio, to make sure we have that, trying to get that better carry, but still maintain all that convexity for a tail risk sell-off.
I'll add to, the volatility portion, we did not, the initial construction there was not based on a 30-year back test, because there was nothing, I think the longest manager had been around since maybe 2012, and we started working on the portfolio in 2019. So we were really looking back to maybe 2015, 2016, which, as Jason said, just like by necessity, it's not obviously stock and bond data. It goes back very far. Trend data, you can get something somewhat reasonable, sort of maybe back to the 70s or 80s, certainly the 90s. That's just not really the case with the volatility portion. So we never sort of had that luxury of having, some sort of like you might with the trend manager with having a 30-year track record. Also, a question about someone living in India, exposure to the U.S. market. I think we reached out to this person individually, but as I said, we do have a Cayman fund for non-U.S. investors. I know we can't advise on the specifics of tax situation in any given country. Obviously, that's outside of our expertise, but we do have some investors that have switched over there or come in through that vehicle because it makes more sense for their setup. Also had a question around sort of like sort of a broad question, but I'll kind of summarize here, kind of like expected theta decay or expected sort of bleed, so to speak, in the volatility strategy. We can come up with a reasonable number there for sort of the tail risk portion of the book. But broadly, like, if we're looking at our theta numbers or sort of any of the option Greeks, they're changing every day because most of the portfolio is being actively traded and they're moving around. So ultimately what we're relying on there is a qualitative assessment of the managers and their ability to adjust to different environments. So there's just not really a very clean way for us to calculate that or come up with it. Jason, is there anything else you want to add there?
No.
Okay. We also had someone ask about the differential on the year-to-date performance of the volatility and stock strategy versus the S&P and vol separately. I mentioned this when we were going through the sort of main presentation, but historically the long vol plus stocks was just the S&P plus the volatility strategy, and so you could look at the estimates for those two and figure out what the long vol plus stocks return was going to be, pretty closely within a few basis points. Given the addition of the overlay strategy that's rebalanced daily, it's not going to add up in the same way because it's going to depend on the performance of that that overlay and the daily rebalance strategy there. So that's how that number is now. That's how the performance is now being realized. Again, we'll send out a link to the Q2 webinar where we go over that in some more detail. We've also updated on the new website. If you click on any of the strategies and scroll down to the bottom, there's a deep dive questions section that also contains an explanation of how that strategy is currently constructed and sort of what's going on under the hood you can see. And then final question that came in sort of in the registration is sort of the management company and where things are at for us and what's going on. I covered some of that just in sort of the updates of what's going on. But yeah, I think, we feel quite good about where the strategies are at, where the company's at. This was it's a bit, we sort of initially built this as a side project that we were going to put some money into and friends and family. And so we made some decisions in how we structure the company up front that we would be break even at 5 million in assets under management. So those decisions have also been nice because it gives us a lot of flexibility in terms of how we're managing the company and sort of what we're able to do with the strategies. And then I think the final question that came in the chat was someone asked about the dispersion of long volatility and trend managers. Are losses driven by equal performance among multiple managers, or are there outliers? So Jason can maybe speak in more detail, but there's certainly dispersion among the managers.
Yeah. So once again, for anybody that came in late, we recorded this and we'll get out the recording as well. But like as Taylor showed in the beginning, Q3 was much more of a tighter range across all managers in general for the year, comparatively to let's say last year or 2022, our volatility space saw a dispersion of upwards of 60% between managers. So like I said, it was, as Taylor showed maybe in the first slides, much tighter in Q3. But just to give you an idea of year to date among trend managers, we're looking at a dispersion of about 14%. And then amongst the long volatility managers, we're looking at about 22% dispersion. So much tighter than last year so far. But once again, this is why we build ensembles, so we can harness that dispersion between managers. Jeff might have a drop, but if not, Jeff, is there anything you want to add to that?
I'll just add that the risk weighting between managers. So say you have that dispersion and it's a manager who's 5 times more volatile than another manager, that's not going to dominate the portfolio and the gains and losses because it's risk weighted to the manager B in this example. So ideally the profits and losses are the same. They're going to, what you're talking about dispersion, they're going to have different signs from time to time, right? One might be up 15, one might be down 5. But if they're both up 15, we expect, or if they're both down 5, we expect the performance to be equal.
Yeah, maybe just to clarify, I think Jason said that I think in 2022 we had our best vol manager was up 40 and our worst was down around 20. So that's about like the 60% dispersion. So, and I think, yeah, we have looked at this. I don't remember off the top of my head, but I think our best performing vol manager in 21 was in the bottom half, and 22. So sort of year to year, have seen the dispersion of, from my recollection, when we looked at it, the dispersion wasn't super consistent across time.
Right. And as Taylor referenced when we were talking about the commodity trend slide at the beginning of the presentation, this is exact dispersion you should see amongst commodity trend managers as well. It's also why we tranche their look backs. But historically, you've seen large dispersion where last year's winner is this year's loser and vice versa, which is once again, reiterating why we love ensemble approaches.
Yeah, and that's just to hammer that point home a bit. If there was no dispersion among the managers and they were all doing the same, there's not much benefit to diversification and rebalancing between them. But sort of the more dispersion there is across those managers, the more the benefit of the rebalancing is. So I think so far we've seen quite a bit of dispersion, which suggests to us our sort of ensemble approach is the correct one.
Except for your slide for Q3, where if they're all down, they're all down.
Yeah, that's exactly. No, sometimes that's how it goes.
Yeah.
But yeah, thank you everyone for joining. I think that's it with the questions. As Jason mentioned a few times, we do have this recorded and we'll be sending it out in the next few days. But thank you all for attending. If you have any questions, Taylor at mutinyfund.com, Jason at mutinyfund.com. Feel free to drop us an email. We're happy to answer our email or hop on the call and discuss. So have a nice day. Thank you.
Thanks everybody for spending your Wednesday with us.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants of this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.